Okay, class. We're going to talk about sales transactions and sales returns and allowances. Some of this is actually a recap of a previous video. However, to simulate how this all comes together, I want to kind of backtrack a second to the sales transactions so I can simulate how we actually return items when a customer wants to return them. So, if you will follow along with me in your books on pages 261 all the way through 265, we're going to kind of recap a little bit of the actual sales, and I'm going to do some of the journal entries for you, and then I'm going to show you how we do the return of items. So just as a recap, let's look at the actual journal entries for how we do sales. Again, cash sales are very easy. We know, again, that we're going to debit what we got, credit how we got it. And I'm just going to set this up real quick. Now, if I had cash sales of, say, $1,800 and my cost of merchandise sold was $1,200, I need to demonstrate these by doing what we consider to be the official method of recording a transaction, which is an actual journal entry. Now, you would have source documents. This would be an invoice or some type of bill letting you know how much these items cost, because you're not just going to make this stuff up. This information comes from actual source documents. So if on page 261 I'm simulating the journal entries, we're looking at cash sales. So we're going to debit the cash account for $1,800 because that's how much the company received. And then we're going to credit the sales account for $1,800 because, again, that's how much revenue the company just earned. But keep in mind that we're going to immediately follow all sales transactions up with the cost of merchandise sold entry. And to abbreviate and to save some time, I'm just going to abbreviate cost of merchandise sold as COMS, as previously discussed in a previous video. So cost of merchandise sold, abbreviated, is $1,200. And we are going to credit the merchandise inventory account by $1,200 as well to reduce this particular account. Now, always, with every single sales transaction, you are going to record the sale and then immediately follow it up with the cost of merchandise sold transaction. This is not a choice. This is 1, 2, always. Even if you have a situation of selling items on account, as discussed on page 262. If I sold this on account, I would debit accounts receivable for $1,800, credit sales for $1,800. I would then do the cost of merchandise sold for $1,200, and the merchandise inventory, and I'm going to abbreviate again, merchandise inventory for $1,200, and then I would send off the invoice to that particular customer. Now, when that customer comes back to pay me, this is just going to be a simple entry of receiving a payment, which would be a debit to cash for $1,800 and a credit to accounts receivable for $1,800. These are your very simple, basic journal entries that happen throughout the course of a merchandise business. However, on occasions, people like to return things. Whether they broke it, they didn't like it, maybe they wore the dress one time and decided they never wanted to wear it again and said, you know what, let me just take this back and get my money back for it. So in that particular case, what we have to do is we have to now go ahead and record the receipt of getting this information or getting these particular items back. So what we're going to do is I want you to flip over to page 263 all the way to 265, where we talk about sales returns and allowances and credit memos. A credit memo is simply just a memo within the computer system that lets the accountant know that a credit was issued back or something was returned. However, again, it's the journal entry that we're looking for because we're journal entry driven within the accounting system. So instead of simply just reversing these particular items here, this journal entry and this journal entry, which would come natural to reverse those if somebody brought it back, we actually want to capture the return in what we consider to be that contra revenue account. And that would be the sales returns and allowance account. So let's say on page 265 that the customer is going to bring back $225 worth of merchandise to be returned. Well, in that particular case, what we're going to do is we are going to debit, set this up, debit sales returns and allowances, remember this is the contra revenue account. We're going to debit that for $225, and then we're going to credit, say, cash or accounts receivable if this customer bought this on account. I'll do cash because it makes it a little easier, but understand that we can also replace this with accounts receivable and apply it right back to that customer's account and leave a credit on their account. But in most cases, we're generally returning cash right back to the customer, so we're just going to keep it easy with the cash transaction here. Now, once I've done the return, I also have to immediately follow this journal entry up with the cost of merchandise sold, reversing, in essence, putting inventory back into my system and taking that expense away that's going to show up on my income statement. So once this item is returned, we see that merchandise inventory is now debited for $140, the cost of the items that were returned back to the store, and then we're going to credit cost of merchandise sold. Again, I am just abbreviating for timeliness here, $140. So you can see that easily with the journal entry that we make this kind of simulated just a little easy. However, it's not always as easy as this in the real world. We know that we do not live in a perfect world at all. We understand that people are going to buy things, people are going to break them, they're going to return them, but we have to keep in mind as accountants, it is our job to do the journal entries that make all of the accounting system work together seamlessly, so in order to keep operations running properly.